Welcome to vTalkInsight, Market Drivers Daily for July 3rd, 2026. Geopolitical friction in critical energy choke points, France's fiscal debate, and mounting liquidity stress in private credit are converging into a complex backdrop for risk pricing. Let's start with how the latest tensions are reshaping the macro path through energy and supply chains. Geopolitics around the Strait of Hormuz remain a swing factor for the macro outlook because they sit directly on top of the world's energy and shipping arteries. Earlier this week, we highlighted a fragile truce in the region, even as oil benchmarks have been relatively subdued. Since then, actual disruptions to Hormuz traffic have pushed oil prices higher, increasing firms' production costs and weighing on demand, which has shaved growth and temporarily lifted inflation by around 1 to 2 percentage points. The picture is now shifting from acute shock toward partial stabilization. Conditions around Hormuz have steadied somewhat, and that is expected to ease the inflation pulse and allow growth to resume, particularly in Europe, where the near-term macro risk from this episode looks to be receding. That reinforces the disinflation and soft landing narrative that dominated our recent discussions on AI-driven growth and resilient earnings, even if the path has been bumpier than many hoped. Beyond the immediate spike, the more durable story is about structural costs and rewired supply chains. Several European powers now seem resigned to paying transit fees to Iran and Oman for ships passing Hormuz, effectively accepting a new cost layer in a key energy corridor. At the same time, major Gulf exporters like Saudi Arabia and the UAE are investing in alternative routes via the Red Sea and Fujairah to reduce dependence on Hormuz tolls, signaling a gradual reconfiguration of global shipping patterns. Other geopolitical flashpoints add to this risk premium backdrop. U.S. tension with Iran and Israel keeps the Hormuz outlook highly unpredictable over the next couple of months, while pressure on Cuba's energy supplies and sanctions linked to the Ukraine war, including strains on Russia's space sector and satellite revenues, illustrate how geopolitics can erode strategic capabilities and trade flows over time. Companies exposed to complex supply chains, such as European Aerospace, where Airbus still needs to deliver more than 500 jets this year despite bottlenecks, remain vulnerable to further disruption. For macro and portfolios, this mix points to a fading near-term stagflation scare, but a stickier geopolitical risk premium in energy and logistics. If stability around Hormuz holds, headline inflation in Europe could drift lower again and growth momentum may stabilize. But any renewed disruption or escalation could quickly revive volatility and pressure both bonds and cyclicals. Key watch points now are transit fee implementation, the pace of investment into alternative routes, and any new flare-up in U.S., Iran, or regional tensions. This evolving energy and security backdrop feeds directly into how governments manage their budgets and fiscal cushions, which is where we turn next. Fiscal policy is back at the center of the story in Europe, with France as the focal point. The country faces elevated fiscal risk as a fragmented parliament makes passing budgets harder, increasing the likelihood of a larger deficit and limiting the scope for pro-business reforms. The government is targeting a deficit near 5% of GDP this year and aims to push it below that level next year. But officials openly acknowledge that recent crises and fragile political support make this a challenging task. Markets appear less concerned about who exactly forms the next government and more focused on how fiscal consolidation is achieved. Orderly adjustment with a credible budget path could keep volatility contained, whereas disorderly consolidation or failure to pass a 2025 budget at all risks policy paralysis. The finance minister has warned that a budget impasse would effectively freeze fiscal policy and stall pro-business initiatives, which could unsettle both equities and credit. Bond markets are already starting to price this policy uncertainty. French government bond volatility may rise into the elections, and spreads could widen especially if both far-right and far-left forces gain ground, given concerns about more expansionary and uncertain fiscal stances under either scenario. That said, demand for French debt remains solid for now, reflecting lingering confidence in the country's overall fiscal management and the expectation that some form of consolidation will eventually take place. On the equity side, European stocks may still enjoy a near-term positive phase in the second half, helped by stabilizing macro data, but the election calendar in France could cap the duration of that window. In contrast, U.S. equities are currently supported by strong profit growth, underpinned by AI-driven investment, relatively supportive budget deficits, and robust net exports, which together create a more favorable earnings environment than in many European markets. Over the longer term, planned infrastructure investment in Europe, including water recycling and strategic minerals, is aimed at bolstering economic resilience and strategic autonomy against exactly the kind of geopolitical and resource risks we discussed earlier. How these projects are funded will intersect with the next theme: the evolving role and risks of private credit. Private credit is moving from a quiet backwater to a key transmission channel for liquidity and credit risk. Funds in the sector are seeing a pronounced surge in redemption requests, with exit demands in the latest quarter exceeding those of the previous one and more than $14.5 billion of investor capital now gated, in some cases with a potential wait of up to 2 years. Managers report a spike in client inquiries, signaling both higher interest in the asset class and rising concern about how liquid it really is under stress. The pressure is not evenly distributed. Vehicles with significant retail investor exposure, including some managed by Ares, Apollo, and Blue Owl, are experiencing the heaviest redemption flows, and several have restricted withdrawals. A segment of retail investors that entered via aggressive wealth channel sales has proved quicker to pull capital, adding to flow volatility. By contrast, more diversified and counter-cyclical managers, such as Oaktree and Goldman Sachs, report fewer redemption requests than software-focused peers, underlining growing performance and flow divergence within the asset class. Despite the strain, current signals still point more to a technical liquidity squeeze than to broad credit deterioration. Private credit performance has remained robust so far. Spreads are tight, and there are limited signs of widespread underlying asset stress. Uniform application of gating agreements is helping to manage outflows and reduce the risk of disorderly liquidation events, though elevated redemption demand is expected to persist for several quarters. However, there is a growing concern that value destruction in some portfolios could emerge over a longer horizon, even if today's marks look stable. The main medium-term risk lies in refinancing. Earlier this week, we discussed how smaller and more leveraged borrowers that locked in low coupons in 2021 face a tougher environment as higher rates bite. That theme is now front and center for private credit, where shorter-dated corporate financing is already showing rising default risk, and refinancing risk is a key concern for the second half of the year and beyond. If policy rates stay restrictive and growth slows, pressure could build on weaker credits, especially in funds already managing high redemption queues. Watch for shifts in default trends, any widening in private credit spreads relative to public markets, and changes in fund terms, such as gating or withdrawal limits. Together, these will shape how private credit interacts with banks and public markets in the next phase of the cycle. To wrap up, tensions around the Strait of Hormuz have delivered a short, sharp stagflationary shock, but recent stabilisation is easing immediate macro risk even as structural energy and shipping costs drift higher. France's fiscal debate and election outcome now looks set to drive European spread and equity risk premia, especially given the contrast with strong, AI-supported earnings and more supportive deficits in the United States. In parallel, private credit is grappling with persistent redemption pressure and gated capital, where today's issues are mostly technical but could become more fundamental if refinancing challenges mount over the next few years. As always, the balance between growth resilience, policy choices, and credit conditions will shape cross-asset opportunities and risks in the months ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.